The socioeconomic hypothesis is that things we often think of as causes are not causes at all, but effects, and the things we think of as effects are causes.
The general consensus on the street and in the market is when there's a move in the market, this move was catalyzed or triggered by a piece of data, a piece of news, an economic event, that this cause and effect relationship starts with the outside cause affecting the market. Socioeconomics reverses that.
Very rarely do we consider the hemline on skirts to be related to politics, or the type of popular music going on right now to be related to the economy. That's not usually the way we think. And this hypothesis challenges you to think that way.
To further illustrate this point, Proctor applied the socioeconomic insight to the Enron scandal.
When the Enron scandal broke, it was a common view that it discouraged investors and hurt investor confidence. The fact is, it did nothing of the kind.
In this chart, Proctor shows that the social mood, represented by the stock market, had trended negatively for a year and a half before the Enron scandal broke. As the scandal developed, stocks actually rose, and so did other gauges of social mood, such as consumer sentiment.
It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets, and it took them 24 days to go bankrupt.
Just an immediate sense of outrage at Lay and Skilling and Fastow when people realized how much they had profited and how completely artificial the appearance of this company had been.
That nobody could really understand, and in fact that many of Kenway's lieutenants questioned. They said this business can't be making this much money legitimately. Something weird is going on.
Mark-to-market accounting allowed Enron to book potential future profits on the very day a deal was signed. No matter how little cash actually came in the door, to the outside world, Enron's profits could be whatever Enron said they were.
Things that fascinated me was that almost all of the Wall Street analysts who covered Enron had buy ratings or strong buy ratings on the company's stock.
One analyst who didn't buy the company line became an enemy of Enron. Enron's CFO, Andy Fastow, had his eye on John Olson, one of the only analysts skeptical of the Enron story.
Enron loved analyst strong buy recommendations.
Merrill was informed by Fastow, either you get somebody who is on board with us and has a strong buy recommendation and loves us at the same time, or we don't do any business with you.
Merrill Lynch fired John Olson. Soon after, Fastow rewarded the bank with 2 investment banking jobs worth $50 million. His job was to cover up the fact that Enron was becoming a financial fantasy land. To please the boss, Fastow had to figure out a way to keep the stock price up by hiding the fact that Enron was $30 billion in debt. Enron was just stashing its debt in Fastow's companies where investors couldn't see it. LJM was Fastow's most ambitious creation. It would work magic for Enron, and it would allow Fastow to conjure $45 million for himself. Returns that would exceed 2,000%. 96 individual bankers invested in LJM, and America's major banks put up as much as $25 million each.
The Enron fraud is the story of synergistic corruption. There are supposed to be checks and balances in the system. The lawyers are supposed to say no. The accountants are supposed to say no. The bankers are supposed to say no, but no one